For more on the outlook for M&A, let's talk to Peter Hall. He is founding partner of the Valence Group. That's an M&A advisory company which focuses on the chemicals industry. Thank you so much for coming in. Now, when I was speaking to Graham McKay, I asked him, was he ever concerned that at one point, because of the volatility and market jitters, he wasn't going to be able to clinch the deal? Does it make it much more difficult, or on the other hand, does it make it more relatively attractive for companies to merge in this kind of uncertain environment?
Well, I think in the past, volatility has always been the enemy of M&A, and CEOs have always been historically concerned about whether or not the price that they're paying is a fair price. I think what's happened is CEOs at the moment feel like there's a bit of a disconnect between the underlying value of the targets that they're looking at and the stock price. Many CEOs feel that stock prices have overreacted on the way down, and therefore they see good opportunities from a value perspective. The strategic drive to do M&A remains, and therefore they see, if anything, perhaps more opportunity than they did 3 months ago.
And this is especially true for the chemicals company, because I guess you can at least save yourself a bit of money by combining, by providing synergies at a very tough time when governments are cutting back spending.
Absolutely, and in the chemical sector, the other thing that's happened over the last few years is the chemical companies have had a very good run. They have very, very strong balance sheets, and therefore they feel like they have the financial capacity to do deals. They are very concerned about establishing a global footprint. Leadership from a global perspective rather than a regional perspective is what's important to them, and therefore, if anything, what we're seeing is really increasing the appetite for M&A rather than decreasing it.
In this kind of environment, are we going to see more hostile M&A takeovers or friendly ones? Because I remember a couple of years ago there was a real backlash against the hostile M&A ones because, you know, the CEO said even if you do merge the two companies and it makes financial sense, it might not be a good fit if actually the people just don't get along.
Yeah. I think that we won't really see too much of an increase in hostile deals because there is an additional element of risk now in the market that there wasn't 6 months ago. A hostile deal in itself brings some risk because typically people don't have the opportunity to do due diligence. I think the combination of those factors means we won't necessarily see much of an increase in hostile activity, even if the overall level of M&A activity continues very strong.
All right, thank you so much for being on the program. Peter Hall there from the Valence Group.